Warren Buffett's 13F filings are public record. Every quarter, the SEC requires Berkshire Hathaway to disclose exactly what it owns, and millions of investors read each one. In Q3 2022, the filing showed Berkshire had just purchased $4.1 billion of Taiwan Semiconductor, one of the most significant new positions in years. Yet, the investors who followed him in never saw the Q4 filing coming. The following quarter, Berkshire sold 86% of that same position. Copying the holdings is not the strategy. By the time a position appears in a 13F, Buffett has already done the analysis, placed the trade, and in some cases is already reconsidering it. The framework that produces the decision is what matters, and he has explained it publicly for 60 years. 5 rules consistently applied. This episode is those 5 rules and 3 stocks that currently pass every one of them. My name is Phoebe, and you're watching Trading Key. The 5 rules Warren Buffett has applied for 60 years. Rule 1 is circle of competence. Buffett's definition is not about whether a business is complex. It is about whether you can predict, with reasonable confidence, how the business will look in 5 to 10 years. He passed on Google for years, not because it was a bad business, but because he could not reliably estimate how the advertising model would scale or what it would face from competition. He called it a mistake in hindsight. The practical test is this: write down in 2 sentences what the company does, how it makes money, and why customers keep coming back. If you cannot, you do not own it yet. Rule 2 is pricing power. Buffett's shorthand. If you raised prices 10% tomorrow, would customers leave or would they grumble and pay? Coca-Cola raised prices 8% in 2023. Volume stayed flat, then recovered. See's Candies raises box prices every year and demand holds. Apple charges over $1,000 for a phone and sells more of them each year. A business with pricing power keeps more of every dollar it earns as costs rise. A business without it passes every cost increase directly to shareholders as margin compression. Rule 3 is return on capital without leverage. Buffett's metric of choice is return on equity, but only when it is achieved without significant debt. A company can manufacture high ROE by borrowing heavily. That is not the same as a business that is genuinely productive with the capital shareholders have trusted it with. The businesses Buffett has held longest, including American Express, Coca-Cola, and Moody's, generate 30 to 50% ROE with modest balance sheet leverage. The returns come from the business model, not the capital structure. Rule 4 is predictable earnings. Buffett avoids cyclicals, commodity producers, and most technology companies because their earnings are difficult to project 5 years out. The revenue base he prefers grows with demographics, consumer spending, or infrastructure spend, all of which are more predictable than competitive market share battles. He looks for businesses where you can draw a plausible earnings trajectory 5 years forward with low variance on the outcome. Rule 5 is valuation. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The corollary is that price matters even for wonderful businesses. He passed on Disney in 1966 because he judged it too expensive. He bought Coca-Cola in 1988 when the market was undervaluing its international growth potential. A wonderful business bought at the wrong price can still be a poor investment for the first several years. 3 stocks that pass every rule right now. Starting with Visa, ticker V. Rule 1. Visa is a payment network that takes a fraction of every transaction. When you tap your card, Visa earns a fee. It lends no money and takes no credit risk. That last sentence eliminates the primary risk of financial services companies and is easy to state in 2 sentences. Rule 2. 4.5 billion Visa cards are accepted at 130 million merchants across more than 200 countries. The network effect means each new merchant makes the card more useful for every cardholder, and each new cardholder makes the network more valuable to merchants. Raising fees slightly affects no one's decision to use the network. Rule 3, return on equity consistently above 40% with low leverage. Rule 4, earnings tied to global consumer spending, which grows with population and inflation and has never permanently declined. Rule 5, roughly 28 times forward earnings. Not cheap, but not extended for a business with this earnings quality. Buffett held Visa at Berkshire for years and described payment network businesses as exactly the kind of toll road model he valued. Greg Abel sold the full position in Q1 2026. The business did not change. The framework gives the same answer it always did. Second is Moody's Corporation, ticker MCO. Berkshire has owned Moody's since 2000, and Buffett has not sold a share. Rule 1. Credit rating agencies provide ratings that bond market participants and issuers require for market access. If a company wants to issue a corporate bond to institutional investors, it needs a rating. The regulatory designation that confers this status is extremely difficult to replicate. Rule 2. Pricing power is structural, not competitive. Issuers pay for ratings they cannot avoid obtaining. Rule 3. Return on equity north of 50%, achieved without excessive leverage because the business requires almost no capital to generate revenue. Rule 4. Earnings tied to global debt issuance volume, which grows with the global economy and is less volatile than equity markets. Rule 5. Roughly 36 times forward earnings. Expensive. Buffett has held through higher multiples because his horizon is long enough that the compounding offsets the entry price. Third is Costco Wholesale, ticker COST. Rule 1. Costco charges an annual membership fee for the right to shop in its warehouses at near-cost prices. Most of Costco's profit comes from the membership fee, not from markups on goods. Rule 2. The moat is self-reinforcing. Costco stays cheap by staying large and stays large by staying cheap. The 2024 membership renewal rate in North America was 93%. Customers who have already paid their annual fee have a strong incentive to shop there enough to justify renewing. Charlie Munger called it one of the best businesses in the world. Rule 3. Return on equity around 35%, with conservative use of debt. Rule 4. Consumer essentials. Recession-resistant demand, and subscription-style revenue with high renewal rates. Rule 5. Roughly 53 times forward earnings. This is expensive by any conventional standard. Whether it passes the valuation rule depends on your confidence in the growth trajectory. Buffett would say this is the kind of business worth paying a premium for. Whether 53 times is a fair premium is the question. The checklist is only useful if you apply it honestly. The most common mistake investors make with a framework like this is using it to confirm a position they already want to own. The Taiwan Semiconductor example in the hook illustrates the alternative. Even Buffett applied the checklist, bought the stock, received new information, and sold 86% of it within a quarter. The framework does not guarantee a correct result. It guarantees you are asking the right questions before you put capital to work. 3 practical applications. Before you buy any new stock, write down your own answers to all 5 rules without looking up analyst reports first. If you struggle with Rule 1, what does this company do and why do customers keep coming back? Stop there. Rule 1 is the gate. Second, run the checklist on stocks you already own, not to find reasons to sell, but to verify that the reasons you bought are still intact. If the moat has narrowed or earnings predictability has declined, the checklist will surface it. Third, notice when you grade a stock as failing Rule 5 and buy it anyway because you like the business. That is the decision Buffett makes knowingly with a long time horizon. Making it unknowingly is how you overpay for great businesses and wonder why the returns disappoint. Which of these 3 is already in your portfolio? And how would you grade it on the 5 rules? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.